Okay, time to get started on long-term liabilities. And in this section, we're going to talk about mortgages payable and bank loans payable, the long-term portion. So we're going to have a look at those and see if we can't make sure we understand those, mortgage amortization schedules, types of payments that we have. We're going to talk about those, the journal entries that we need, and balance sheet presentation for those. So let's have a look here. First off, if we look at long-term liabilities, mortgage loans are related to land and buildings, and other long-term loans are related to property, plant, and equipment and are very similar to those mortgage loans. Make sure you know how to prepare a mortgage amortization schedule, and we're going to look at one today. And as well, the current portion of any long-term liability is shown as the current portion of long-term debt. So we're going to show that on the balance sheet presentation as well. All right, payments, blended versus fixed principal. Well, blended payments are payments of interest plus principal. So on any loan, when you make payments, you'll pay principal and interest. The mix of interest and principal changes each month when we have blended payments, but the total amount of the payments remains the same. So if our payment is $10,000 and in the first month we pay $4,000 in interest, well, then we're going to have $6,000 principal. Next time, you might have, say, $3,800 of interest, and then we'll pay $6,200 worth of principal. But the total amount of the payment remains the same. It's always $10,000 in that case. Now, contrast that with fixed principal loans, where it's a fixed principal payment plus whatever the interest is that needs to be paid. So, for example, we could have a payment of $5,000 of principal that we pay every month, but the interest will probably go down every month as time goes by. So the monthly payment does not remain the same in that case. Now let's have a look at a mortgage amortization schedule. And we'll just shoot you over to a different screen here just for a second. Pop this on in here. Now, a mortgage amortization schedule is basically a schedule that shows the payment that's going to be made, and in this case I've chosen monthly blended payments, what the interest is that's paid in that payment, and this is the payment on February the 1st of 2021, and what the amount of principal is that's paid, and the ending balance after that principal's been paid. So again, let's have a look at this particular loan. It's $1 million loan issued January 1st, 2021. Has a 5% interest rate, and we're going to make $10,000 monthly blended payments. So our first payment is February the 1st, and the opening balance is $1 million for that loan. We're going to pay $10,000 of combined interest and principal. And there's the amount of interest that you'd have for the first month, the $4166.67. The principal payment is $5833.33. The total together of those two payments or two amounts is the same $10,000. Take that beginning balance, or the balance that we had at the end of last month, take off the principal payment of $5833, and we'll owe $994,166 because we've made that small payment there and we've done well. That continues on for a number of months, and you can see at the end of December after the December 1st, 2021 payment, we now owe $934,000. Well, that's good. That works out just fine. We paid down some principal on the mortgage. That's great. We're paying $10,000 a month towards it. We will have paid a bunch of interest, but we have paid some principal, so that's good. Interestingly, we can look forward another year, and here's the payments for the next year. In the January 1st, 2022, here we are making these payments of $10,000 each. There's the principal reduction right there, $3893.67 for January the 1st. The interest, that's the interest of $3893.67. And there's the principal, $6106.33. The total together is $10,000. That monthly blended payment is $10,000. And at the end of the year, so 2 years down the road, we'll have it down to $859,500. And we can tell what the that this amount right here, this is the principal portion that will be paid in the next year. Well, that amount right there is, if you add it all together, is 74,978.80, or in other words, round it to 74,979. That's the amount that we are going to have to pay or show on our balance sheet as the current portion of long-term debt. This amount right here, the 859, we will pay in 2023 or later, but in 2022 we'll pay this amount. So if we look at the balance sheet presentation, so at December the 31st of 2021, so a year, almost a year into our loan, the current portion of the long-term debt in the current liabilities section will be 74,979, and the mortgage payable in the long-term liability section will be 859,500. And again, that 859,500 comes right off of there, right there. That's the amount still to pay. And then here is the principal amount right here that we're going to pay in the next year. That gives you not 74,978. And you can see at the end, the balance of the two combined should be the 934,479. That's the principal balance on the loan. And if you add those two together, you do get the 934,479. So hopefully that made some sense there to you. Back to our PowerPoint presentation just for a second here. We want to look at the journal entries that are required in a long-term loan. And when we've got interest and principal payments every month or every year or semi-monthly, semi-annually, whatever it is, we've got to record two parts to the journal entry. One is the interest, one is the principal portion of the payment. Well, let's have a look at some journal entries then. So for journal entries, the key to keep in mind here is on the date you make the payment, you're going to pay a certain amount of cash out of your bank account. So $10,000, these are monthly blended payments in the loan that we've been talking about. $10,000, a certain amount is going to be for interest. And let's just go back to our schedule here. So the interest on February the 1st of 2021 is $41.66.67. There's our journal entry, $41.66.67. And we know the payment is $10,000 in total, so the difference should be the principal payment. We will reduce the payable, which normally has a credit balance. We're going to reduce it by $5,833. And when we do that, the balance will go down to $994,166.67. So that's the journal entry for the month of on February the 1st. You can see March entry will be March the 1st entry for that another payment of $10,000. We'll have interest of $41,42.36, and that's coming right from here, right from that interest amount right there, from our mortgage amortization schedule. And then one entry to watch for here, and this is the year-end interest accrual. So at the end of the year, we've been making payments on the 1st of every month. So on December the 31st, we owe 1 month of interest on this loan. So it's important to set up the amount of interest that's payable. So we haven't paid it yet. We won't pay it till January the 1st. But on December 31st, we owe 1 month's worth of interest, which is basically the interest paid on the January 1st, 2022 payment. And if we look here, January 1st, 2022, amount of interest to pay is $38.93.67. So we should have $38.93.67 in interest payable. And that's interest expense or interest on long-term debt expense. That's where we put the debit in this side. All right. If we just continue along here and look at our PowerPoint one more time, again, that balance sheet presentation, we talked about that very quick for a moment. You want to look at the current portion of long-term debt and the long-term portion. So this is the amount that will be paid in the next year from December the 31st of 2021. And then this is the amount that will be paid after that amount. So in other words, this will be paid in 2022 or later. And again, we got that off our mortgage amortization schedule. I hope that worked out well for you. And we'll get into capital leases next. Thanks.